And I've had this happen to me. Where do you think the economy is going to go in 6 months? Well, hell, I don't know. But I'm kind of flattered that you asked. And I kind of feel like I have to give you an answer now. So, you've got this call from someone saying, what do you think the Swiss franc is going to do? And you're like, oh, I don't know. I was actually just vacuuming up the office. But here, I'll stop and think about something real quick. It's going to go up, because I think that what's going to happen is those army knives are going to be extremely popular in the post-apocalyptic COVID-19 world that we're going to live in. All right. So something that is just a rumor or a whim, once it's in the financial press, takes on the air of authority.
This is the MMT Podcast with Patricia and Christian Riley. Hi, I'm Christian Riley and welcome to the Modern Monetary Theory Podcast. You can find us on Twitter at MMT Podcast, and you can support the show by going to patreon.com/MMT Podcast. For as little as $1 a month, you can get early access to all our episodes and patron-only episodes. A big thank you to all our supporters so far. At the beginning there, you heard our guest this week, author, cowboy economist, and Texas Christian University professor John T. Harvey, and we're going to be talking to him in a moment about international monetary economics. If you're new to MMT, the headline is that if you live in a country with a modern money system, like, say, the UK, the US, Japan, Canada, or Australia, your government is the monopoly issuer of your national currency, and it can't run out of its own money. And if it's your first time hearing this, you're probably thinking, surely it's not that simple. And in some respects, it's not that simple, and that's why we're on episode 78. That said, if you do live in a country like this and you have people dying from a lack of food or housing or healthcare, and the only thing standing between these vulnerable people and the things that are going to save their lives is a government unwilling to write the check, then it really is that simple. The currency issuer, your government, can afford to spend whatever it wants on whatever it wants without operational limit. If something's physically possible, it's financially affordable. Therefore, unemployment is a policy choice. Poverty is a policy choice. And not putting a dignified floor under everybody's standard of living in a time of abundance is a policy choice. We think the key to rejecting these choices is an informed electorate, but it would appear that most of the media is staffed by well-fed people with no burning desire to challenge the debunked zero-sum economics of austerity. So if you'd like some information you can use and you want to know more about, for instance, how governments spend new money into existence every time they spend rather than using tax revenue, that's our first episode. If you want to know why you still have to pay taxes to a government that creates its own money, that's episode 2. If you want to know why a government that creates its own money does this thing which gets called borrowing, which isn't really borrowing, that's episode 3. If you want something to say to your stepdad when he's blathering on about money printing and inflation over the holiday dinner table, that's our episodes 7 and 65. Or what about your old school friend who did an economics A-level in 1988, who's always banging on about something called the current account deficit? What's his problem? That's our episode 72. If you want to hear all of these things and more explained in different ways by different professors using different words of different lengths, that's pretty much the rest of the series and our ongoing mission to be your one-stop shop for all your family argument needs this holiday season. This particular episode is aimed at your borderline alcoholic uncle who thinks government spending to end poverty, create full employment, and, to use his words, give everyone a free pony, will somehow cause some person in an office on Wall Street or Canary Wharf to push a button marked "Make currency worthless." Why are they still making computers with that button, by the way? It makes no sense. Anyway, we thought we'd approach this subject by asking expert and all-round economic showman Professor John T. Harvey about what does influence currency prices and take it from there. We've touched on these things before in episodes 6, 41, 64 and 72. If you want to check those out, I've linked to them in the show notes, but we're hoping this conversation fleshes things out a bit more for you. Before we dive in the conversation, you'll hear Patricia talk about an episode we did with Italian activist Chiara Zuccarato about the long-standing crisis in the Eurozone, resulting from member nations having adopted a foreign stateless currency, the euro, which, crucially, the individual countries themselves do not issue. This, combined with the so-called Stability and Growth Pact, which should have more accurately been called a Chaos and Contraction Pact, has left Eurozone countries with no scope to manage their own economies and deal with the chronic unemployment, poverty, and other social problems that stem from that lack of control. We also talk about an MMT-informed solution to the Eurozone crisis put forward by our previous guest, Dr. Dirk Entz, and two other co-authors, for a Euro Treasury and a Eurozone-wide job guarantee. And links to these episodes with Dirk Entz and Chiara Zuccarato can be found in the show notes. And as ever, I've linked to where you can support this podcast financially via patreon.com/MMT podcast. Support starts at $1 a month, which is 75 British pence at the time of recording. And no matter what level of support you give, you get early access to all our episodes and patron-only episodes where you can ask me and Patricia MMT questions. We are 100% supported by you, our wonderful listeners. Your financial support really helps keep the show going, and your support in other ways, whether it's by recommending us to other people or just by listening and spreading the word about this stuff, really helps too. Finally, just a plea, when you're rowing with your relatives over the holidays, try to be nice. It's not their fault they're not as awesome as you. Actually, it probably is, but the being nice thing is in some book or other. So, do unto others as you would have done unto someone whose finger was hovering over the make currency worthless button or something. I don't know. It's been a while since I read it. Anyway, thanks for the time you put into understanding MMT. Let's dive in. Welcome one and all to the MMT podcast. I'm Christian Riley.
And I'm Patricia Pino.
And it's our great pleasure to welcome back to the MMT podcast author and cowboy economist John T. Harvey. How are you, sir?
Very well, thank you. Very well. Yeah, I think so. I had to stop and think about it. Yeah, I think I am very well.
So, John, you're the author of Currencies, Capital Flows and Crises, which Stephen Hale and I'm sure many others swear by for teaching international monetary economics. And a big theme in your teaching is that currency prices are influenced chiefly by capital flows. Could you say more about that?
Yes, I could. And let me back up to, I guess, the sort of neoclassical mainstream view of what determines exchange rates. And it's part of the whole overarching theme of the economy fixes itself. If there's a problem, then the problem automatically sets into motion the forces that are going to correct the problem. For example, let's say you start off with full employment, everyone who wants a job has a job, and just for sake of argument, balanced trade. But then suddenly your goods and services become less popular, so your exports go down, so your employment goes down. Well, this is a bad thing. But don't worry, because in the neoclassical scheme, the primary driver of the exchange rate is the demand for goods and services. And think of it this way. And I guess what I'm doing here is I'm backing into an answer to your question by explaining what would the world be like if it were the opposite, if it wasn't driven by capital flows, if instead it was driven by trade flows. And that's the neoclassical version. And so in this world that I just set up here where, everything had been great until exports fell, then if exports fell, then the demand for your currency also fell, because in their model, the main driver of why you want to buy a unit of foreign currency is because you want a foreign good or service. So if people want fewer of your goods and services, then they also logically want fewer of your units of currency, which causes your unit of currency to depreciate. Voila, that's French, until you once again have balanced trade. That once again, the quantity of currencies demanded in each direction is equal. So, the sort of neoclassical version of, why would they say that exchange rates are driven by trade flows when statistically we know that trade flows are a tiny minority of all the international transactions? Why would they say that? Well, it fits into the overall theme of, hey, if your country runs into a problem, there's something that automatically kicks into gear. Just leave those markets alone. It'll automatically kick into gear and solve the problem. And once again, to go through the example one more time with a little bit more background in everybody's mind now, we start off at full employment. and balance trade, and then your goods and services become less popular, so your exports go down, so your domestic employment goes down. That's bad. But if your exports went down and the only reason people buy your currency is to buy your goods and services, then the demand for your currency went down, which means the value of your currency goes down, which then re-energizes your economy. So that's the alternate view, and that's the view I learned in undergrad and in grad school. And I really didn't think it made sense. I can remember the day in the undergraduate course when I asked the question to the professor, who later was on my dissertation committee, actually. I said, but if that's the way it works, then why do we have trade imbalances for long periods of time? Why don't they just go away? Why doesn't every country with a trade deficit experience a depreciation, which then fixes their trade deficit? And every country that has a trade surplus experiences an appreciation, and that reduces their trade surplus. He said, well, governments intervene. And that was the whole answer. Now, we can certainly identify cases where that's true. But in the vast majority of trade flows, the U.S. is not trying to affect the dollar-pound exchange rate, nor is the Bank of England. And so as a consequence, that doesn't really hold up very well. So when I got done with grad school, my goal in grad school was to get done with what I was learning there, so that I could then go on to learn this stuff called post-Keynesian economics and later institutionalist economics that I'd heard about at the time. And so, of course, post-Keynesian traces back to Keynes, and Keynes has some wonderful stuff on financial markets. And I'm thinking, well, shoot, that's just the exchange market. The exchange market is a financial market because, in fact, 90-some% of all international transactions are really to buy a foreign financial asset. So if that's true, if I decide that the U.S. stock market is more attractive to me, then by a sort of derivative of that is I must therefore buy dollars. So that's going to drive the dollar up. So the dollar is going to rise and fall on the basis of the attractiveness of U.S. financial assets compared to financial assets elsewhere. Now, this is really developed economy stuff. I guess when you become a professor, you specialize in terms of your research. I would say I do international economics, but I do international monetary economics, but I do exchange rates, but I do exchange rates of developed countries. But really what I do is the dollar euro, and until, some years back, the dollar Deutschmark. So that's the way it works there. So what I ended up doing was sort of digging into what can I draw from Keynes to sort of give insight into what's really driving foreign exchange rates. And then I also came across the work of a guy named Stefan Schulmeister, a really nice man. And he worked at an Austrian research institute, by which I mean literally in Austria. He wasn't an Austrian. He was an Austrian, but he wasn't an Austrian economist. Well, actually, that's not true either. He wasn't in the Austrian school of thought, right? And he did some wonderful, very pragmatic, kind of like, what kind of research would you do if your head wasn't already filled with wrong ideas? And sort of going in and looking at what do the currency dealers actually look at when they make a trade? What sort of mechanics are involved? He went through the technical analysis, trading, and that, and that's what I'd been looking for. I'd been looking for stuff in the neoclassical literature, and it's interesting. They'll every once in a while pay lip service to the whole. Well, yeah, it's capital flows, but in the long run, it's trade. Well, long run to them is like 10 years, 20 years. So, that'd be kind of like if we had the lifetime of elves, then this would be very useful. I'm sorry, Tolkien elves, not the ones that bake cookies or that live at the North Pole. But then this would be useful information, but it's not really. So, and I don't know how much of an answer you want to that, but it sort of boils down to, and this is what my poor students, we have an exam tomorrow in international monetary economics, where we use my book as the textbook, surprisingly. And tomorrow's exam is one of the things that's covered is, what they call the mental model of what is it that's in the brain of the sort of collective brain of the currency market when they're trying to decide which financial assets do I want to buy? Because then that ends up being what drives the exchange rate.
So is it fair to say that what causes changes in capital flows, movements out of one currency into another currency, are forecasts?
Yes.
Forecasts on specifically financial assets.
Correct. And like up through exam one, what we did was we did some sort of basic structural stuff to kind of give you an idea of where I'm going with all this. And then we went over some psychological characteristics from psychology literature, availability, representativeness, anchoring, blame avoidance, all these sort of features of how people go about making decisions, on the assumption that what we're really trying to explain here is the behavior of these currency market participants, and behavior that is really the forecast is what we want to know, the forecast that they're making. So then on exam 2, we kind of took that sort of basic background information and then became more specific. Okay, these are general characteristics. We end up with bandwagons because of these psychological characteristics. We end up with volatility because of these psychological characteristics. But what are they looking at? What specific variables do they tend to look at? And I have this diagram, the mental model diagram that I have, where it's got like interest rates, relative growth rates, relative inflation rates, and so forth, as sort of a guide to thinking about, if I'm somebody trying to understand the currency market, where should my focus be? What variables, should I be looking at? And that's the exam tomorrow. I also have a big fancy 4-quadrant diagram thing too we do, but part of that is the forecast. The forecast creates real outcomes. There was a wonderful model that I used to use before I'd come up with something myself by a guy named Rudiger Dornbusch, who apparently was a really nice man, neoclassical guy, but otherwise nice guy. And he had this beautiful 4-quadrant diagram. The bottom right was the domestic economy. The top right was the financial sector. The top left was the currency market, and the bottom left was the trade balance. And I basically copied that, but did it with post-Keynesian assumptions on the way these different things operate. And one of the things that always bothered me about his model was that he did have an example of where, let's say that people's expectations changed. What impact will that have on everything else in the macroeconomy? I was like, yes, I want to know that. Except in his model, the market participants must have the same expectation that Rudiger Dornbusch has, which he built into his model. So it must be that they must believe what economists, in that model, believe would be true in the end. So they can't think something contrary. And in mine, they can. All right, that they have an independent effect that doesn't simply rush us to the point where we're going to go to anyway, which is kind of where he comes from. No, so that was a long answer to your question, Patricia. But yes, it is forecasting and expectations that is the core issue.
The reason why I'm asking, because when it comes to pricing financial assets and expectation of the financial asset return, what they call. It's based on, it's not completely disconnected from what they expect the economy of the performance of the overall economy of a country to be. Is that related to inflation?
Well, let me back up to what you said about the forecast is not totally unrelated to what they expect the economy to do. And that's absolutely right. One of the things that John Harvey argues in the book is that while on the one hand, they could believe that it's sunspots if they wanted to, and that would move the exchange rate. But they don't. They believe that it is, trade for goods and services, trade for financial assets, and government policy that they have to keep an eye on. So what they're focusing on in general, I would argue, is quite reasonable. But the problem is you can't really forecast those things. And so, as a consequence, whereas in Dornbusch's model, they always came to the right answer. In a post-Keynesian approach, there is no right answer because we don't know the future. We don't even know the future. And this gets into a whole other concept that really was big for Keynes, uncertainty. But we simply don't. It's not that people in Keynes's models act irrationally. It's that they lack sufficient information to act rationally. And the fact that they act at all is a surprising thing coming from the animal spirits. And so yes, they are focusing on the actual real world economies as much as they can. I mean, who would have picked the Liverpool score last week? And yet there are many, many fewer moving parts in Premier League football than there are in the world economy. And I think Leicester got slaughtered too, and Man U is perhaps becoming a lost cause. But my Gunners are still doing okay. Sorry.
All right, if there are any Tottenham Hotspur fans out there, don't write in. It's not my fault. He's an Arsenal fan.
And that's my cousin, by the way. It's one of the Tottenham Hotspur fans. Have you seen the scene in the movie In Bruges where, and I can't remember the actors' names now, but they're staring at this Dante's Inferno portrait, and it's like, well, that's purgatory, the place where, and he uses a bad word, so I won't do that, where you're not really, really good, but you're not really bad either, like Tottenham. And Patricia, you asked about inflation, and that right now is just not a big factor. It has been in the past when in the 70s, when there was a lot of inflation. But among developed, and again, here I'm thinking of developed economies and not developing economies. With developed economies, there just isn't that much inflation to start with. So interest rates are probably the key, most important thing that you're going to look at. Because first of all, if I'm buying financial assets in the UK, all right, I'm not going to look at individual stocks and bonds. I mean, that's a job in and of itself. And really what I'm betting on is that the pound will appreciate, right? So if I'm really betting on the pound appreciating, then I'm just going to buy a government bond, or I'm going to buy a stock index. But I'm not going, it's a tremendous amount of work to forecast which way you think the pound is going, let alone to then also pick and choose among the various financial assets in the stock market. So the interest rate then ends up being, well, I'll just buy a government bond. I mean, or I'll have a deposit in a bank account, because that's almost virtually assured. And if the U.S. interest rate is higher than the U.K. one, then that promises me, everything else being equal, a free higher rate of return. But then, of course, that'll also cause the dollar to appreciate, which will, eliminate that higher rate of return. It'll become more expensive to buy in the U.S. Yeah.
So let me just throw this thing out here, that see what you think. There's this phrase, nobody ever got fired for buying IBM. I think it kind of applies here a little bit. So the idea is it's such a safe bet that IBM stock will go up, that if you invest the money and trust it to you as a money manager, and you buy IBM stock, but then the stock goes down, nobody's going to blame you for making that decision. And if you don't buy it and it goes up, you'll be the one fool that didn't just take the obvious free lunch. So does that at least partially describe the bandwagon effect that you talk about in your teaching sometimes? Yeah.
And it's interesting. They talk about that in the psychology literature, and Keynes mentions it specifically in the general theory. But let's not use IBM though. Let's use something riskier. The U.S. .com stocks in the 1990s. So these things are skyrocketing. And let's say that you, as an individual fund manager, are thinking, well, but there's no way, because I think the market in general gained about 20% per year in real terms for like 5 years in a row. So that's compounded. I mean, it makes no logical sense whatsoever. So you're sitting there in year 4 of this long run up thinking there's no way that this price can, the .com, for example, can continue going up. So I'm not going to create for my customers a portfolio of assets that includes as much. Well, what's going to happen to you? I mean, all your customers, well, my buddy down there at the country club says that's a good one. And you're going to get in trouble with your boss. It is better to fail conventionally than to succeed unconventionally. If you didn't put it all together, put in the .com stocks and you were right, well, you got lucky. But if you did put them in there and it collapsed, who could have known? And I have a friend here in town who has been a stockbroker for probably about 30 years now. Sad to say, he was one of my students once, and yet he's been in the job market for 30 years. He was one of my very first students. And I do a lot of computer gaming. So we were on the phone during the 90s, talking probably about Diablo 1 or Diablo 2, whichever one was out at that point. And Mike says, oh, hang on, I have a phone call. And he comes back and he says, I must get at least one of these a day. Somebody asked him, and I'm going to do a dumb Texan accent, hey, what do y'all know about Bob.com? And Mike says, hang on, I'll look it up. I can't find anything about it. Well, give me $10,000 worth. And Mike's like, okay, you heard the part about I can't find out anything about it. Well, that's all right. A buddy of mine says that's a good one. He said, okay, I'll get my commission and my conscience is clear. And I ran into him at the store the other day and he said, oh my God, he said that happened constantly. So there's this tremendous pressure on these fund managers to follow these trends, even when they don't think they make any sense. But there's more than that. I was just showing my class this yesterday. Let's say a price is going up, 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 and you think the underlying reasons for it to go up are gone. Well, but there's still money to be made. So there's no reason to sell it yet. In fact, what you're going to do is you're going to wait And I don't know if you have musical chairs in England or not. Where you get, it's a way to teach children how hard life is. You get like 5 chairs and 6 kids, and you play the music, and then you stop. Everyone has to sit down.
I hated that game. I always lost at that game.
But that feeling you have when you're walking around the chairs, there's not going to be enough. But as long as I can beat everybody else, I still win. I mean, so it's the same thing in the financial market. The price is going up. You believe the underlying reasons are gone, but there's no reason for me to sell just yet. And if I'm sitting here with my finger on the enter key for sell, then I'm going to ride it as long as I can and see what I can make. So all these fascinating facts about the financial market and the stock market that I didn't learn any of in graduate school. Nothing whatsoever.
Just to follow on from that bandwagon effect thing, here's another hypothetical for you. Now, this is just totally me off the top of my head. So I'm thinking, let's say it's no deal Brexit day is looming, right? Investors think it's obvious on that day the pound is going to plummet, right? It will probably recover, but on that day, it's a sure thing that it'll plummet. They believe it. They adjust their positions accordingly because nobody got fired for buying IBM, right? Nobody will blame them if they bet on the pound going down and somehow it doesn't. And as they adjust their positions, selling the pound, moving into another currency, it ensures the pound goes down. So, really, and this is not investment advice to anybody listening, but so how can the pound not go down? People like to talk about the market being jittery, like it's neurotic, but it all seems to me like everybody in that mechanism that I just described is acting rationally. Does that sound reasonable? Rational in the sense that with the information they have, they use it in a way that's most likely going to make profit for them. But absolutely, it's a self-fulfilling prophecy, but quite reasonably so. As a matter of fact, it's funny you should mention that because my first exam question has, and I perhaps should stand up to say this, Her Highness has decided to take over the government again, and that this has been met with great enthusiasm and a belief that the pound will appreciate now. And so then there's work through this whole scenario of what variable does that affect in the model, and what will adjust to this, which way will capital flow and so forth. But I have kind of the opposite scenario in the exam tomorrow, where the pound is going to appreciate because finally a logical, reasonable government is going to take over. And I finished off the question with God bless her, and I don't know if I really get that or not, but GAWD Also, in your teaching, you've talked about how there's a feedback loop between the press and the currency traders. Is there more to say?
Yeah. As a matter of fact, something you said a minute ago reminded me of, this is from the research of a guy named Thomas Oberlechner, who got his PhD in psychology at some school called Harvard, and then decided he was really interested in exchange rates. And I thought, oh my God, this is what we need. Somebody who has the expertise to, do studies and analyses, who is interested in this particular area. He's a dean now. I email him now and then. I was like, what the hell? Somebody else could have been a dean, but nobody else could have done what you were doing right now. But apparently he likes it. So anyway, but
he's blocked you.
He wasn't thinking of us at all. One of the papers he wrote, and I'll come back to your specific point about the feedback loop with the news. But what you said earlier about people saying the market is jittery, people talk about the market as if it's distinct entity. And it's just them. I mean, the market is just them. It's that group of people who are buying and selling in the financial market. It's not independent of them. And so one of the papers he wrote, he had interviewed these currency dealers to figure out what metaphor do they use to understand the currency market. And it was very interesting because he came up with both a explicit and implicit. Explicit is what they said out loud. Implicit was if you read between the lines, though, really, it sounded more like this. You'd give them a series of choices. Their explicit metaphor was like a competition, a bazaar, a place to buy and sell. And obviously that is what they're doing there. But he also felt like they thought they probably should say that. But he said when you read between the lines, really they thought of it more as like an ocean, that is this massive force over which they have no control as an individual. It has periods of calm, it has storms, and we're all doing our best in the interim, just to try to navigate it. And so anyway, just this sense of powerlessness that they each have individually. And by the way, there is a very strong feeling among currency dealers that a very few big players drive the prices, by which I mean banks, not central banks, private banks, that they watch those banks to see what they do because they feel like their volume is such that they can drive the prices by themselves, not on a daily basis necessarily, but often enough to pay attention to it. But then another paper he wrote, he said, okay, he asked these dealers, what is your primary source of information when you're sitting there in front of your computer trying to decide whether it's going to go, up or down? And they said, well, the financial press, which seems quite reasonable. And then he also interviewed members of the financial press. And he says, okay, well, what's your primary source of information when you're writing an article about the currency market? And they said, well, the currency dealers. So the interesting thing is that the primary source of information for the currency dealers is the financial press. And the primary source of information for the financial press is the currency dealers, which I was just talking about this in class yesterday, which to an extent makes perfect sense. Who else would you talk to? But here's the problem. And I've had this happen to me. Where do you think the economy is going to go in 6 months? Well, hell, I don't know. But I'm kind of flattered that you asked. And I kind of feel like I have to give you an answer now. So, you've got this call from someone saying, what do you think the Swiss franc is going to do? And you're like, oh, I don't know. I was actually just vacuuming up the office. But here, I'll stop and think about something real quick. It's going to go up, because I think that what's going to happen is those army knives are going to be extremely popular in the post-apocalyptic COVID-19 world that we're going to live in. All right. So something that is just a rumor or a whim, once it's in the financial press, takes on an air of authority. So he was concerned with this sort of feedback loop that you can get where things that are rumors or whims can take on an air of authority and then drive the market. Now, is this a long-term problem? I don't know, but it's just doggone well fascinating. I love reading stuff like that. It's like, oh yeah, that makes perfect logical sense. And I'll tell you something else from that same paper. He asked dealers, what is the most important characteristic of news that you receive? How accurate it is, the source of the news, and so forth. And the number one item was I got it first. Number two was accuracy. And it makes perfect sense because the example I use for my class, I remember I was pulling in to work probably 20 years ago. Whenever George Bush Sr. was president.
The elected one.
Yes, that's right. The one-termer. And so I was listening to the radio and they were talking about, the dollar had fallen earlier in the day and then it had gone back up again. And they were asking the financial analyst, David Johnson, and they said, wow, that's really, wild. He said, oh, no, it happens all the time. He said there was a rumor that George Bush had been shot. The dollar fell. It turned out he wasn't shot. The dollar went back up. And there was a second rumor that this was all started by a Japanese company that wanted to buy dollars. So you say that this has happened, it falls, you buy your dollars cheap, and then it goes back up again. So, that kind of stuff students find fascinating, I have to tell you, these little things like that.
So this system where you have what a tiny number of people think, it drives forecasts, that drives capital flows, that drives currency prices. Summing up, that's the line of causality. Okay.
Yes.
What effect does that have on people on the ground in our economies? I know that's a big question, but
no, it's a great question. All right. So, because I've actually got some examples and stuff. Let's see now. When I got to get I have my book right here. I was going to say I got to get my history right. I've got a whole chapter. Something that really annoyed me in class. Okay, I started as a physics major. It turns out that that's not the route to be an astronaut, as I thought it was. So I quit that.
There are very limited jobs in that as well.
Yeah,
and very competitive, I hear.
Yeah, you're going to be a test pilot or something like that, not a physicist. Yeah. So I quit that. And then I thought, well, what do I really love? And it's actually, international relations. So, in fact, I'm sitting in a room full of war games right now. There's the Pacific War over there. Twilight Struggle, fantastic game on the Cold War. But that's the last ad I'll do there. Sorry. And so I went to political science. And in political science, something I really appreciated was that when I got done with class and I went home that night and I watched the news, I understood the news better. You know, today the Mozambique People's Liberation Army did so-and-so. Hey, I know who the MPLA are, and I know who's backing them. And I was like, wow, the news makes more sense to me. I never got that with economics. I never got that same feeling. If they had said on the news, today the demand curve shifted to the right, okay. Or today the price elasticity of demand did so-and-so, but there was a less of a connection, direct connection between what I was learning in class and what I was then being able to apply in my trying to understand the way the world worked. Obviously, there wasn't no connection because I wouldn't have stayed in it. But now what I didn't like in political science was the lack of the formal models. I like the formal modeling. I really do. That may be a weakness, but it's part of the self-selection, of course, that goes into this. So anyway, that was a long way of saying chapter 6 in the book is real world applications, because by God, I wasn't going to have a book where here's the theory, figure out how to use it yourself. Instead, I wanted to have a section where it went through and explained, okay, this is what happened from, dollar run up 1980 through February 1985. And then I go through and explain how, in the context of the graph and of the mental model, how you would interpret all that. So I am now glancing through here to make sure I get the last. After the euro was introduced in January of 99, it fell for a long time. And it became really weak compared to the dollar. And why? Because of speculation, right? I mean, this is not, it's really hard to build a reasonable story of exchange rate fluctuations that is related to imports and exports being the driver. Even the neoclassicals will admit that because they say, well, that's why they have to go to the long run. So this is being driven by, I had to go back and look and see what was driven by. I don't remember anymore. But interest rate differentials and, the speculation that the euro might not be such a good idea and stuff like that. The euro falls for a long time. Okay. Fast forward to us interviewing job candidates. And one of our job candidates was from Belgium. And I was talking to him about, how did you, learn your English? Was it simply from school? He said, no, his father is an importer-exporter who was just about wiped out by the fall in the euro. Because what that did to him was he was buying American stuff and selling it in Europe, probably baseball gloves or something, I don't know. And as the euro was depreciating, everything American became much more expensive for him to buy because he had to pay more euros. But he couldn't really jack up the price in Europe, the euro price, because then he wouldn't be able to sell it. So he said he was almost wiped out by that. And I actually jotted something down here earlier that you had asked in your email about the Swiss franc. And so I was looking up some specific information about it. And it was talking about specific companies that became into very serious financial trouble because of fluctuations in the franc euro exchange rate after the Swiss decided they weren't going to hold the price constant anymore. So absolutely, there are very serious. And in order to understand this, I have a couple of articles where I started adding into the last couple of exchange rate articles, which has been a while since I've written exchange rate stuff. I've actually kind of gotten into business cycles since then. But I put in these articles, the percentage change in the exchange rate over this, given periods of time, and the fluctuation in currency prices is absolutely horrific in the real world. And yet people take it for granted. And if you were to think to yourself that inflation took place at the same rate, we would be marching on the White House for very different reasons than we may want to right now, but they have a wall around it now. And let's see here. This is from an article that was in the Journal of Economic Issues in 2012. Exchange rate behavior during the Great Recession, John Harvey, how exciting. And at the end of the article, it shows that in the period from January 2006 to March 2008, that's just about exactly 2 years, the dollar depreciated. This is the pre-financial crisis collapse of the dollar. The dollar depreciated by 28% over the course of 2 years. Now, think for a moment if we had had 28% inflation over the course of those 2 years. This would have been an absolute outrage. It would have been the headline. And yet that's exactly what happened. Everything foreign, and this is the dollar euro, everything European or in the Eurozone became 28% more expensive to Americans. But wait, it's okay, because over the next 11 months, it then appreciated by 18%. These are wild fluctuations. But then over the next 9 months, it fell by another 17. And then over the next 7 months, it went up by 16. And then over the next 12 months, it went down by 18. These are massive fluctuations that are taking place in the currency market, and they absolutely have real world effects. And I'll tell you one of the things that I hypothesized a long time ago, but have never tested, and that is that I would assume that this really wreaks havoc on the small, most competitive importer-exporters, and it leaves the big players untouched. And so we have increasing concentration in the market because this exchange rate volatility sort of weeds out the people that, even mainstream economists would prefer to have, and that is the smaller competitive firms. So, sorry, long answer to your question. Yes. I agree with your line of causation, and it has real world impacts.
Okay, so how does looking at these things change if you apply the MMT lens? Now, I'm thinking about Warren Mosler will say regarding interest rates that most people have got the gas and the brake confused. Raising rates can impart an inflationary bias rather than slow things down because of the interest income channel. And lowering rates does the opposite. And because interest rates are playing into this whole model that we're talking about, I just think that must be quite interesting, because I'm sure a lot of these currency traders aren't really using MMT. The MMT view of interest rates, it's not really playing into their calculus. So I just wondered if you had any thoughts on that.
Yeah. First of all, one of my daughters, when they were in grade school, and I don't remember why I was explaining this to them in the car, but I do this to people. And I was explaining how our central bank raises interest rates in order to try to control inflation. And either Meg or Alex, one said, wouldn't that make prices higher? Because it makes everything cost more? I was like, well, yeah, that's Now, I haven't really ever looked at the sort of overlap or implications of MMT for exchange rates, which is a bit of a problem since I'm writing a chapter for a book right now, an MMT volume on exchange rates. But I'll tell you where I'm coming from in that chapter. One of the things you always hear with MMT is that, it'll cause the currency to collapse. Either it's going to cause runaway inflation or it's going to cause the currency to collapse. There's no way you can do that. And so what I try to do in the chapter is I start off and saying, okay, well, where are they coming from? Why would they think that in the first place? And now let's say, okay, that's why they think that's true. Now I'm going to tell you why it doesn't work, because the premises of that argument are not reasonable. And of course, the argument really is the same thing as the inflation argument. And that is that if we, and I'm going to use the horrible term, print money, then that will cause inflation. And gosh, there's so many problems with that argument. But anyway, that will cause inflation. And then if we have inflation because the value of a currency is locked into the prices of goods and services, which it isn't, but because the prices of currencies are locked into the prices of goods and services, if our prices of goods and services are going up, that will cause a trade deficit, which will cause the currency to go down, down, down. All right. So it's really simply the same neoclassical argument that exchange rates are dominated by trade flows when they're not. So think about it again then. Let's stop and say, okay, but one could argue that, but an MMT policy would cause capital flight and everyone would leave, right? And then that would cause the dollar to fall. Okay, that would cause the dollar to fall. You're right. But why would an economy at full employment have everyone leaving is the part I've never been able to understand. I mean, we're not talking about a disastrous, oh no, the economy is just like it was during World War II, where we have less than 2% unemployment. And, there's so much demand for goods and services, we can't keep up with it. I'm not investing in that country. I'm getting the hell out of there. No, there's actually quite reasonable arguments to believe that it would cause people, not that we want the dollar to be stronger, because that doesn't necessarily a plus, or there's pluses and minuses, but there's certainly no powerful argument unless you're going to build it on those same clearly counterfactual assumptions of the way the currency market and monetary policy work.
Is it fair to say then that when you get a big event say, no deal Brexit or Brexit for that matter, or even just a Brexit vote, or something like, a Jeremy Corbyn government, which was also kind of a really unique event. When you have that, then you would almost certainly get that kind of almost panic reflex of, get out, almost like avoid the risk at all costs. And then, as you say, but if the economy, if you have full employment, then that creates an environment which is ultimately profitable for companies to be in, which in turn would eventually bring back those very people that maybe pulled out at the earlier stage. It kind of reverses itself over time anyway.
Yeah, so what you're saying is that the initial announcement of a Bernie Sanders government with AOC as his vice president, or vice versa, I don't get away.
Christian is dancing, for those who can't see it.
That might initially cause the dollar to fall because of the panic selling. Yeah, I think that's absolutely, that's certainly possible. In the stock market fall.
Also, that thing of just like it's received wisdom that it's going to go down. So the dealers themselves might have totally different ideas. There might even be Sanders supporters, but it's just they're just like, look, I'm going to look like an idiot if I don't just go, sort of bend in the wind here,
Yeah, and once the run starts, it's almost as if in the musical chairs thing, people have rushed up and pulled out extra chairs. You got to get the hell out as fast as you can, or sit down, I guess in that case, as fast as you can before a chair is pulled away. So yes, that's quite possible. And so therefore that particular country would find it easier to export for a while because the prices of their goods and services would be lower. But that's certainly a possibility, just as it was with the New Deal in before World War II in the U.S., that there's all these, business people saying how terrible this is going to be. And granted, Pearl Harbor really accelerated the whole New Deal thing, but we ended up with 1.9% unemployment in the U.S. So does that pull the money back or not? And the other side of it is, of course, why do we care? About the capital flows, because we've got our own money. The bottom of, at the end of the day, now it will be a fight, just like it was for FDR, to convince people, no, this is actually a good idea. Well, to convince the people who dominate the airwaves that it's a good idea. Yeah. But no, I think that's a very realistic scenario, Patricia, that's exactly what would probably happen. And but not for the reasons that people suggest. And there would absolutely be a logical reason for it to then recover afterwards.
As people on the ground, as voters and stuff, you're like, okay, well, maybe it's a bit more expensive if we go on holiday or something. But we're at full employment. There's just like millions of people now, just really secure. Yeah. So you've got they're spending money, right? Which is good for business, surely. Yeah. And you've got what it's going to do for the nation's psyche to sort of like remove this constant anxiety that people and it's not just people who are unemployed suffering that anxiety, it's that threat, it's it's that tension that it places on pretty much everybody.
It's also your health insurance in this country.
We touched on this a couple of beats ago. I use your Forbes piece, money growth does not cause inflation, all the time to help people understand where they're going wrong when they use that framework of, we've created more of a thing. So it means now that each unit of that thing must be worth slightly less because we've created more of it. And Warren Mosley's got a nice riff that he does. He just goes, no, but we're the monopoly issuer of it. Monopolists are price setters, not price takers. So that he can go down that route. And then there's a slightly more complicated thing about how the government sets price, even though it doesn't know it, by the prices that it pays when it spends and the collateral demand of when it lends. And that's a bit more complicated. We've talked about that before, but your Forbes piece is a kind of deconstruction of the MV equals PY framework. Would you be able to unpack that for a minute?
Yeah, I was just talking about this in class the other day, and I like to pick on the Milton Friedman article that he uses to talk about, we should have a constant money growth rate. And so I think the best way to start, and by the way, that chapter I'm writing, that's how I have to start, is with the MV equals PY, because that's what then leads into the supposed collapse of the exchange rate. So Friedman has this island where, and I don't even need to explain MV equals PY, because everything's going to make sense without the equation. Friedman has this island where everything's in equilibrium to start with, which is fair enough. I mean, all of us do that. We'll start at equilibrium, then we'll throw it out of equilibrium, see what happens. Everyone who wants a job has a job. Resources are fully employed, and everyone has as much cash in their pocket as they want relative to their income. All right. So that's a very important part of this, that we want some cash for, an emergency, for transactions that might take place, something like that. We want to hold on to some cash, maybe some cash in our checking account, just for convenience sake. And he, assumes a ratio for that. Okay. So, and everyone's at that ratio. All right. Now here comes the Federal Reserve. And the Federal Reserve is a helicopter. I can't imagine being able to get this published, but the helicopter drops money out on the island. All right. And people hurriedly gather it up. All right. People already had as much savings as they wanted, so they go out to spend it. Only there isn't any more stuff than there was when it started, because we're already at full employment. So when they went out to spend the money, all they did was bid up the prices, because it was impossible for firms to produce more because they were already at full employment. So all they did was bid up prices. So therefore, monetary policy, increasing the money supply, causes inflation if we're already at full employment. And what he ends up arguing is, okay, so let's say the economy grows at about 3% a year. Then maybe the growth rate of money supply should be about 3% a year, or maybe a little higher, because some inflation is helpful to people that are, debtors and so forth. So he says 4 or 5%, but whatever we make it, constant number, and leave it there, because the government shouldn't be trying to manipulate the economy. And he's making the argument not on a moral basis, although I think way down deep that is what he's doing, but on the basis that they don't have sufficient accuracy to do that. All right. What's wrong with that? First of all, the helicopter engaged in fiscal policy, not in monetary policy, because monetary policy cannot make you more wealthy. It can indirectly. Recently here, the U.S. Financial market has been propped up by the Federal Reserve. So, in a sense, it did drive, but not in the sense of your current income. He actually increased people's income. So the helicopter was actually engaging in fiscal policy. If he wanted it to be analogous to monetary policy, the helicopter needed to land. And I keep picturing the Grinch who stole Christmas. I don't know if you have that fine film cartoon over there, not the one with, not the live action one, the original, with Boris Karloff doing the narration, which has nothing to do with the discussion here. If he wants to make it correct, and again, I picture the Grinch here, you land the helicopter, and then the Grinch sneaks off to your house, and the Grinch exchanges $100 for $100 worth of your financial assets and carries them back to the helicopter. That's monetary policy. Monetary policy is exchanging one financial asset for another. And remember, too, that in Friedman's model, it was assumed that everyone had as much savings as they wanted. So the term that the monetarists and neoclassical Keynesians like Krugman use is that Friedman created an excess supply of money with the helicopter drop. Excess in the sense that this is more money than I want to hold on to, so I'm going to go spend it. And I got into a very pleasant disagreement from that very article with a fella named Marcus, who was a monetarist. I refer to him as Marcus the monetarist when I talk about him in class. I got his PhD at University of Chicago, where Friedman was. So this guy is pretty dedicated. He was very pleasant, and he disagreed with the piece I wrote in Forbes. I said, well, I think I opened with, but it's impossible for monetary policy to create an excess supply of money. So his first thing is, of course, there can be an excess supply of money, or we would never have inflation. All right. So then I said, okay, how does the Fed accomplish this? Given the tools the Fed has available, discount window or whatever they call it nowadays, I can't think of the name, of loans or open market operations. How do they do that? I swear to you. He follows up with, well, it's like when you put logs in a fireplace. I said, no. How does the Fed do it? Well, it's like planting trees in an orchard. No. How does the Fed do it?
I know exactly what
analogy after analogy after analogy. Now, we all use analogies. They're very useful. But analogy implies analogous, and it wasn't. And so he finally ended with something like, well, I guess we must agree to disagree. It's very interesting because I go over that story with my students because I say, what we really disagreed about was not monetary policy. We disagreed about method and about what do we respect as evidence. Because Friedman had that famous thing about, it doesn't matter how unrealistic a model is as long as it predicts well. And he goes on to say, in fact, oftentimes the most significant models are the ones with the most unrealistic assumptions. Okay, hey, that's stupid. Of course that's not true. Because the real world is a perfect model of itself. And so then as you make it less realistic, well, you have to because we have to model. And so it doesn't matter to Marcus the monetarist whether or not the Fed can do it or not. It simply doesn't matter. Whereas the post-Keynesian approach is realism, where you really focus in on what's the causal links. This led to this, led to this, led to this. I need to know what it is in the real world. Am I going to have to simplify? Of course I am. But hopefully something that's analogous to what we're talking about. So so you go back to that whole discussion, you reread it. It's like an atheist and a fundamentalist Christian arguing over a Bible passage. We are coming from such different perspectives to start with that really the superficial argument is not really what's going on. There's a lot more to the MV equals PY thing, but I shall stop there because it's probably the most entertaining part.
So, John, when you mentioned about this belief that central banks are there to control the money supply and therefore, and thus control inflation through that, the whole argument falls apart if you consider bonds to be money. This is what puzzles me. How are bonds so different to reserves that they make that distinction so definitely? And I guess also if exchanging bonds for reserves is, as they say, creating money, which is QE, then is purchasing bonds destroying money?
Well, that brings up something that I read from Paul Davidson, the famous post-Keynesian guy years ago. He says, problem number one is we are defining money by example and not by function in mainstream economics. Defining by example, what's a planet? Well, a planet's something like the Earth. Okay. Well, geez, the moon is a lot like the Earth. It's certainly a lot more like the Earth than that garbage can over here to my right is. So that must be a planet too. Well, no, it's not. All right. So when you define by example, you can never close the window and you can never understand how to classify a new phenomenon or a different phenomenon like bonds. And so he's saying, we should define by function. A planet is a heavenly body that revolves around a sun. Well, the moon revolves around the Earth. So there goes that. So I think part of the problem in neoclassical economics, you're talking about their argument, is they're defining money as reserves and not bonds. And so it's a definition issue. One of the examples I use in class to explain how the financial system really works, I have this bank make a loan. Banks can create money out of thin air too in the private sector. They create credit money. And so what happens is, let's say that I make a loan, but that causes my bank to be below the reserve ratio that is required by the Federal Reserve. So what I do is, I let's say I'm $1 million short, I sell $1 million worth of treasury bills, and I have the cash now instead. All I really did was adjust my portfolio of assets in order to meet a rule, but nothing else changed in terms of the actual purchasing power in the macroeconomy. And I think what you were going more for, if I'm not mistaken, is that as a form of saving, you can't use a bond at ASDA, but as a form of saving, it is indistinguishable from cash, except in the sense that it also earns interest. And so if we want to go deeper into that, I think there's a terrible understanding of inflation and what it is to start with. I would, if I was going to deconstruct this whole inflation thing, I said, let's back up and talk about what inflation is to start with. The whole argument that full employment might cause inflation, and I'm going to be heretical here. So what? I don't care.
Yeah, so what? It's full employment.
Yeah, that's right. And guess what? The Emancipation Proclamation made the price of cotton go up. So what? That wasn't, prices change. If we want the people in this country, in the U.S., people who are below the poverty line to have more money, to have more income rather, that might be inflationary. To pay people a decent wage to pick crops in the field so that we don't end up using desperate people to do so, that might be inflationary. It might well cause the price of vegetables to go up at the grocery store. So what? People view inflation as something that attacks all of us at the same time, and it doesn't. People gain and people lose from inflation. Inflation is a side effect of a redistribution of income. What happened in the greatest period of inflation in U.S. history, recent history, in the 1970s, because of the OPEC oil embargo? It had nothing to do with Federal Reserve policy. And I can't imagine why these neoclassicals still hang on to that, but it had nothing to do with the Fed. They tripled the price of oil. And oil was used for many other, it wasn't like, I just won't use any oil then.
Yeah.
If they tripled the price of, coasters, all right? They tripled the price of coasters. Okay, I'm just going to fold up bits of paper from now on. But not with oil. And so what was going on there? Well, they were ticked off at the West for helping Israel in the 73 Arab-Israeli war. And by God, this time they weren't going to get away with it. And so they were able to agree on quotas. And boy, was there a redistribution of income, a huge redistribution of income across the globe. So whenever I'm thinking about inflation, I always want to think first, there isn't just inflation. What's causing it? And who's gaining from it? Because somebody's gaining. And sometimes I might be perfectly okay with them gaining from it. And other times I might not. I don't say this out loud. Of course, I am right now. The argument that, with MMT, once we reach full employment, we won't be stimulating the economy anymore anyway. So that way there's no inflation. Okay. But I don't care if there is. Because if the inflation is resulting from the fact that we are no longer destroying the middle class and have people have decent incomes and that I have to pay more for a Big Mac, so be it. If we pay people a decent wage to do things, then we're going to have to pay more the people that are, already have the decent wage. But there's also many benefits we're going to get from that as well. So I don't choose the MMT will not cause inflation hill to die on, because I don't care if it does or not, depending on, the source, of course.
Yeah. So everything we just said about what affects currency prices, it's different for developing countries. Okay.
So there was some really good stuff done by Nina Kaltenbrunner, who is at Leeds University, on exchange rates. And she had taken some things that I had done, and then she's like, okay, let's expand this to developing economies. And I now teach that in class, what she talked about, because it gave a tool to differentiate between the way life is in a developing country and a developed country with respect to exchange rates. But it is much more complicated, because here's problem number one. The United States is not desperate for a particular foreign currency that we can then use to buy, technology or something like that from other countries. People aren't anxious to get hold of the peso, but people are anxious to get hold of the dollar. And this is one of the things that she was talking about in the paper. There's a hierarchy of currencies in the real world. And so when I'm talking in a paper about developed economies, yes, the dollar is the world reserve currency, but the euro ain't too far away. Well, they tried to be far away there for a while, but perhaps it's settled down now. The pound, none of these things, there is a tremendous difference in the safety associated with it, but there is with the peso. And so when you're Mexico, you need dollars, all right? People will not simply accept pesos for goods and services. In America, people will accept dollars for goods and services, all right? So it's a wonderful situation to be in. And to, a large extent, euros. And those are all legitimate forms of savings, but the peso is not. So that immediately creates a problem for Mexico in that they need to attract foreign currency. Now, and there's so many things to say. Who you ought to talk to is Eileen Graber at University of Denver. She's done some wonderful stuff on developing economies over the years. And, some of the stuff I'm telling you is just drawn from her work. But anyway, that means that Mexico then is in a tough spot because they need to attract foreign money, which means that they need to possibly have higher interest rates than they really want in terms of, needing to keep up the value of the peso and to attract this foreign money. And higher interest rates, I know it's a secondary factor for economic growth, but it's still a factor. I mean, you'd still rather have low interest rates than high interest rates in terms of encouraging growth. And then also, you better not have many capital controls. If you're a developing economy that needs to attract foreign money, people aren't going to go into your financial market and buy your Mexican stocks with dollars if they feel like you can shut down them taking the money out tomorrow. And yet that's exactly what they need to do, because these hot money flows can be horribly devastating. And the crises part of the book talks about that. I'm trying to think of how much the peso fell in 1994, 60%. The peso lost in value. And so it was a dramatic collapse in the value of the peso. Same thing happened in the Asian financial crisis because there were no capital controls. Of course, that's what attracted the money. So that means that they have to give up a lot of control if they want to attract this money of their own financial markets. And that often doesn't turn out well for developing economies because we're just there for the money. And we're not really there because they have a long-term interest in the money, in the economy. Now, Eileen Grable has written some really good stuff on, I believe it was Chile had some really effective capital controls in place when Mexico had the crisis. And of all the Latin American countries, they were affected the least. And they said, okay, you can invest here, but you must put a compensating balance at the central bank that's going to earn no interest. There's a penalty if you withdraw early and so on. So we welcome your money here in Chile, but you better really be interested in Chile and not just making a little money and getting the hell out, because that's going to wreak havoc on our financial system. So those are a couple of the issues you end up talking about with developing economies that don't come up with developed.
In that case, in Chile, what we hear is the reason that you don't have capital controls if you're a developing nation is because the investors don't like them and it scares them away. So how did they walk? I imagine it was a real sort of regulatory tightrope walk, diplomacy tightrope walk to get just the right level of control.
I don't know really, but I would guess that they simply didn't get as much money, that they simply didn't get as much. And you have to ask yourself, am I sorry I didn't get the money that might pull out overnight?
Yeah.
No, I'm not really sorry about that. And so that's what you have to do. Something that it's just something else that every time I read one of her articles, I learn something new that I hadn't thought about before. And she wrote a piece after the global financial crisis on how a lot of developing economies are now giving up on the international organizations. Screw the World Bank, screw the IMF. They were of no help to us whatsoever. And they are organizing locally. And they are intentionally holding the values of their currencies down to raise exports, to get trade surpluses, to then collect foreign reserves to use in case something bad happens again. So you've got, dollars and I suppose yuan and, euros and so forth piling up in central banks in developing economies because they don't trust us anymore, or the international organizations. And she thought that was a very effective solution. She actually connected it to some other philosophical approach. I can't remember what it was now, but I thought that was very interesting. They said local solutions made more sense anyway than a one-size-fits-all, World Bank or whatever.
You touched on, in one of your classes, Keynes's Bancor plan, which we've talked about on this podcast before. It never got taken up, obviously, and it was to do with Keynes really wanting to keep the Americans on side. But you likened the Bancor plan to being like the NFL draft.
Yeah.
Obviously, I know less about American football than I know about UK football, which is not very much. But I thought that was a neat little way of describing it. Can you remember it?
Yeah, well, actually, and let me do it with the Eurozone instead, because it's the same problem. You've got all these countries in the Eurozone, and it's lots and lots of fun for Germany to screw over Greece in the short run. In the same sense that in the National Football League, it works very differently than the Premier League, in the sense that teams are restricted in the players that they can select every year. There's a draft every year, and the teams select players from those. They don't just get to have a foreign investor to give them millions of dollars and then buy players. Although I understand why the EPL works that way, because they then have to compete internationally. And in the NFL, they don't. They just compete internally. So what they do with this draft, though, is the team that has the best record and wins the Super Bowl gets last pick out of, 32 teams now? Yeah, 32 teams. And the worst team gets the first pick. Well, gosh, that seems un-American. Why wouldn't the best team get the best pick, And the best teams have to play a slightly harder schedule. They've actually sort of standardized the schedule making nowadays, so it's not as big a deal as it used to be, but they have to play a harder schedule. Now, and then you ask yourself, well, why would they do that? And I asked my class, why do they do that? Why do they care? I said, well, they want parity, a chance for the teams to be relatively even. Why do they care about that? Well, because there's more money in it. That's it. If they let the best teams get the best picks every year, we'd end up with 5 teams in the NFL. The others will all go bankrupt. And who's going to want to pay to watch this week's exciting matchup, team number 4 versus team number 2? And that's it. That's all we've got. That's all the teams that are left because all the others have gone bankrupt. It's like we're trying to put together this gladiatorial display. And even the worst team, Detroit was a really bad team for years and years, the Lions. And they had Barry Sanders as their running back, who was a god. Fired up on YouTube and watched some of his runs. To give you an example here, and we're going into the NFL much more than economics, a really good defensive player on another team, Hardy Nickerson for the Tampa Bay Buccaneers, he said he's scared when he goes and plays against Barry Sanders, an offensive player. Now, normally in the NFL, the offensive players are scared of the defensive players because the defensive ones are the ones that are tackling you and trying to knock you down, not knock the ball down and that. Normally, that's the way it works. But him as a defensive player was scared of this offensive player. He said, I find myself just watching him. I go into spectator mode. He is so incredible. I'm like, oh my God, look what I'm supposed to tackle him. I forgot. And that was the thing. Detroit sucked, but they had Barry Sanders. And so you're going to get people to go to the game to see this one incredible player that will be on a 2-14 team. Again, why do they do that? They want the NFL to succeed as an enterprise wherein every franchise is going to make some money. Well, the Eurozone is not working that way because what they're doing is, the Dallas Cowboys, who I hate, by the way, they were winning a lot, about 20 years ago. And the owner of the Cowboys, which is the reason why I don't like them, Jerry Jones, he wanted to change the rules of the NFL to where his team got a bigger share of the revenues from something or other. Well, he's lucky that didn't pass because he would have been the loser eventually on that. But, imagine we would have ended up with just a very few teams and the league would collapse. Well, you end up with a very few winners in the Eurozone and the Eurozone collapses. And when you think back to why this whole experiment started, to prevent Europe from having another horrific war, and that's really scary, that you want this experiment to continue to survive. And as long as Germany is using other countries to boost their own, they have their own jobs program. What they're doing instead of MMT is they're just doing it through exports. That is a actual policy target for them is these exports. And of course, they're really worried about spending government money because they somehow think that's a Weimar Republic. But they are, as Paul Davidson said in the paper, robbing Peter to pay Paul. They are expanding their economy at the expense of the Greek economy. When the Greeks entered the Eurozone, they had a faster rate of GDP growth than the Germans up to the crisis, a faster rate of productivity growth, and a lower ratio of spending on social programs to GDP than the Germans did. But the Germans, trade flows are highly dependent on income. When Greek income goes up, they import more. It's actually relatively elastic. If your income goes up by if your GDP goes up by 1%, your imports tend to rise by more than 1%. So Greek growth, its differential over the Germans is almost exactly how much their trade deficit got worse and worse and worse over those years. And it was the trade deficit that screwed them over. It's a trade deficit that put them in debt to Germany. So they have a system built that punishes the losers and rewards the winners, and it will fall apart, or it will just really suck. And I guess what Greece should really do is quit, but they can't because it's political.
If you think about it, a lot of things work in that way. I mean, I had a guest from Italy a while back on the podcast telling me that, she was very anti-Eurozone and she wanted Italy to get out of the Eurozone. But she said she was convinced that, even when things were looking abysmal for the Euro, that at the last minute, Germany, France, the big countries, they would do something to keep they would make concessions to keep everything afloat.
Right.
And it's like you want to abuse people, but you don't abuse them to the point where the whole thing collapses.
Right.
And you could say the same thing about capitalism. When you talk about the big companies, they want to push down on workers' wages enough to make them a profit, but not enough that the whole system collapses. So it's they make new loans just like the Germans do. They make new loans. So that was what the NFL example was. I'm sorry I went off for a few minutes on Barry Sanders, but
I think that was actually the highlight of the interview. So I would not. I'll probably just cut everything after that.
Right. Yeah. Well, be sure to mention that he won me at least 2 fantasy football championships when he was on my team.
So, all right. So we always like to leave it on a positive note. I will say Dirk Entz, he's come up with a proposal of paper that he co-wrote with another economist and Pavlina Chernova, which is a Eurozone-wide job guarantee. Yeah. So that was their idea for a way to keep it together would be that.
One thing I wish, they talk about if you wave a magic wand, one thing I wish I could get out of people's heads is confusing the market system for the economy. Because the economy is much more than the market system. But you have so many of these these mainstream solutions being somehow we need to stimulate the market system. And it's very difficult to get that across. Well, over here, you're sort of mainstream neoliberal Democrats. That's where they're all coming from. What Biden needs to do to help out the poor folks in town is to get the economy going. And no, job program. I mean, you have to separate those out. It doesn't have to be the market. In fact, right now, there are many jobs that are not market oriented, but people can't see it because of the veil of consciousness over their eyes.
Thanks for everything, John. As usual, you've been an amazing guest. We've all learned so much about American football as well.
Well, thank you both again. I really enjoy it. So anytime.
Thank you so much. That was really helpful.
Thanks, John. You've always got a job guarantee with us, mate.
May the force be with you.
That was the MMT podcast with Patricia Pino and Christian Riley. Don't forget, you can support the show through Patreon, starting at $1 a month and get access to patron-only episodes. You can do that by going to patreon.com/MMT podcast. You can also find me on Twitter at MMT podcast. And you can find Patricia on Twitter at Patricia N. Pino. And you can email us at mmtpodcast@outlook.com. Thanks for listening, and we hope to hear from you.
Oh no, I'm not going to England. See, I've got my US, my UK, and my Irish citizenship.
No, not in Ireland. I mean, the EU has its own problems. So.
Oh, that's true. That's true. But it's a problem that can be solved by a pub being across the street. So
that's true.